Welcome to our Taking Stock video for the week ending the 3rd of May 2024. I'm Kien Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. How are you today?
Very good, Ken. Thanks for having me on.
It's my pleasure, Jace. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any charts or past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, it's been quite a volatile time for equities, especially in the month of April. The Australian market dropped by about 2.7%, while the S&P 500 index, that's the US, fell by 4.2% for the month. So, Jace, what is driving this negative sentiment?
Yeah, there certainly has been a lot of turbulence in the markets, Ken, and I feel like investors are becoming increasingly concerned about the higher for longer interest rate environment. Stronger than expected economic data, such as retail sales, jobs, and wages, have led to sticky inflation, with inflation figures both here and in the US continuing to trade well above central bank targets.
Yeah, and despite the negative market movements, Jace, last month, our star growth stocks portfolios, they continued to outperform the market, and they declined by only about 1.4% for the month. And the outperformance was also supported by our exposures. Remember, we've got quite a few gold stocks there, like Perseus Mining, Alkane, for instance. And also, we've got some lithium exposures which recovered, like Pilbara and Lynas Rare Earths. And the gold recovered on the back of this inflation theme. Meanwhile, though, our star income stocks, they were weighed down by their exposure to retail and REITs, such as stocks like GUD Holdings, Super Retail, Waypoint REIT. And these segments were impacted by the higher for longer interest rate narrative. But of course, the short-term performance is impacted by cycle shifts and investor sentiment. It's important that we look at the long term and say the last 10 years, the share prices tend to revert to the fundamental quality of the businesses as indicated by the outperformance of our star stocks.
Yeah, that's right, Ken. This higher for longer interest rate environment is certainly weighing on market sentiment and on some of our star stocks as well, just like what you've pointed out. Although in the US, the Fed has pushed back on the potential interest rate hike this year, and in Australia, bond prices are pricing in a 46% chance of an interest rate cash rate increase to 4.6% before Christmas. So the RBA holds its policy meeting this Tuesday, and it's going to be interesting what Michelle Bullock has to say. And also mentioned in our previous episodes, higher interest rates reduce equity valuations and keep debt costs higher. And this will in turn not only impact profit margins, but could potentially lead to higher corporate insolvencies.
Yes, we've been on this bandwagon for quite some time, Jason. We need to remain vigilant. In fact, data from ASIC has revealed that the number of companies appointing administrators hit a record high in March, soaring to 1,136, and this represents a 37% increase on the same month in 2023. But let's now turn our attention to a few star stock highlights over the week. The mining stocks, they've released their quarterlies, and if you haven't done so, please review Dan's commentary. But Jace, what were some of the highlights?
Yeah, Ken, it was pretty interesting that Lynas decided not to sell some of its rare earths materials, and this was due to low commodity prices. This action may actually prompt some consensus analysts to pare back their forecasts, and it could impact earnings this period. Based on what we see, there's probably a few things to dislike about Lynas right now, but Dan still thinks it's a strategic play and has very important defensive assets that could generate significant earnings into the future.
Yeah, thanks, Jace. Potential opportunity for the longer term. But within the resources, a major announcement during the week was BHP's takeover tilt for global mining company Anglo American. The share price fell by about 5% following the announcement, Jace. Dan had a really good discussion about this on Lincoln Live early in the week. So, Jace, what are your thoughts here?
Well, Danny removed BHP from our Star Income stock portfolio last year because he believed that the company had reached a peak in its earnings cycle and therefore expected it to reduce its dividends. The fact that BHP is willing to execute such a significant acquisition suggests the company's priority is now focused on delivering growth rather than paying out those juicy dividends.
Yeah, so investors really need to be mindful of investing in BHP for the income, which could potentially be quite volatile. And moving across to financials, National Australia Bank (NAB) they kicked off the May bank reporting season with their first half 24 results broadly in line with expectations. Interestingly, though, Ryan noted that competitive pressures within the banking sector are abating and the net interest margins are stabilizing over the last 6 months, Jace.
That's right, Ken. And this was pretty well received by the market, with the bank keeping its first half 24 dividend stable at 84 cents per share. The bank is also trading on a pretty attractive FY24 dividend yield of 7% and is expected to go ex-dividend on the 7th of May. The stock is currently under review, but it is likely that we will retain it within our Star Income stock universe. We'll do a full wrap-up of the bank reporting season in next week's episode.
Thanks, Jace. Another company to provide a trading update this week was supermarket business Coles Group. They reported a notable 4.2% year-on-year growth in comparable sales for the quarter. What do you think drove this growth, Jace?
Yeah, supermarkets have been a topic that's in vogue recently, Kian. And it feels like a number of strategic factors played out in its performance this period. These include improved stock availability and a slowdown in product price increases. And also we saw volume gains and share market gains as well. The company also rolled out anti-theft technology, and this helped to reduce some of the losses and theft within its stores.
Yeah, sounds quite interesting there, but it looks like their liquor business, though, didn't perform as well, showing a 3.1% drop in their comparable sales. What is the reason for this underperformance?
Well, liquor has always been a bit of a tough segment for the company, and there were a couple of factors such as competitive pricing issues and also a less effective promotional strategy compared to peers like Dan Murphy's from the Endeavour Group. However, the liquor business only represents 9% of total revenue, so whilst the impact is significant, it doesn't really represent the major part of the story.
Yeah, and I noticed that Coles is currently outperforming Woolworths at the moment, and Coles is on a gross dividend yield of 6% compared to Woolworths of around 5%. So from that perspective, Coles currently looks like a more attractive proposition. Now for the week ahead, Jace, with the bank reporting season in full swing, we anticipate Westpac and ANZ banks to release their updates. Both banks are on a gross dividend yield in excess of 7%. So stay tuned for our analyst commentary when it's released. Now for Under the Microscope this week, we take a closer look at ResMed's recent earnings release. The company reported a 7% year-on-year revenue increase and a notable 25% rise in operating profit for the quarter. This has led to positive earnings revisions under Golden Rule 3, Jace.
Yeah, it was a pretty positive report, Kian, and what caught my attention was the elevation in gross margins by around 2.6% to end around 58% for the period. This suggests that management's strategic initiatives around operational efficiencies and also cost outs have been having a substantial impact on the bottom line. But beyond the numbers, Kian, the company also received a pretty strong uptake on their new AirFit F40 masks and also the AirCurve 11 products.
Yeah, research and development is certainly very important for these type of companies, and the stock has certainly reacted positively. Is now trading above that $32 mark. But I'm curious about your thoughts, Jace, on the potential market shifts, and that's due to the introduction of weight loss drugs impacting the sleep apnea device sector.
Yeah, this has been a valid concern and is a factor that has weighed on the share price over the past couple of months. And while current investor sentiment appears a little bit optimistic, the longer term impact of these weight loss treatments are still pretty uncertain and warrants close monitoring. For now, management highlighted that real world data indicates that patients diagnosed with sleep apnea and also prescribed a weight loss drug like GLP-1 are approximately 10% more likely to initiate CPAP therapy. Now, this underscores the potential for weight loss drugs to also complement CPAP machines and could effectively help with treating sleep apnea.
That certainly sounds a bit reassuring, Jace. So with the ongoing positive share price performance, would you advise investors to take profits now or hold for longer term gains given the uncertainties?
And again, very good question, Ken. The stock has rallied quite strongly in recent weeks and continued to trade well above its highs at close to $40 or so. We continue to hold the stock in our style growth portfolio, and the decision to take some profits will depend on the individual. You'll want to figure out whether you want to lock in some of the gains, and if you are uncomfortable with some of the market disruption, this is definitely a path you should consider. But as always, please read our active risk section and also give me a call if you have any other questions regarding the company.
Yeah, and at the moment, Jace, I can see that the stock is trading close to fair value under Golden Rule 5. In comparison, though, other healthcare stocks like Pro Medicus and Cochlear are trading at a premium to fair value. If you're interested in other healthcare stocks, you can use the peer comparison table at the bottom of the 9 Golden Rule screen or contact our analyst if you have any questions. Now, following on from BHP's 60 billion buyout bid for global mining giant Anglo American this week, a useful question is what should investors look for when assessing the overall impact of an acquisition on a business?
Well, in general, Keen, management from the acquiring company tend to inflate the benefits of a potential acquisition, and this is in order to convince shareholders and possibly the board as well to accept the deal. In theory, acquisitions are a means to extract value either through synergies, increase market share, and also potentially improve pricing power of its company.
Yeah, but the value from the deal is also tied to the price paid for the acquisition. And the higher the price, the lower the return on investment, obviously. Therefore, investors should scrutinize the price paid to see whether it's reasonable.
That's right, Ken. And if you have the data, try to compare the price to the valuation of other similar businesses as well. But another important factor is the stability of management. Will the combined management team work together? Will they have the same shared goals? Or could there be egos at play, which could be counteracted?
Yeah, and speaking about management, Jace, you should also look at the management motivation as well. As Charlie Munger once said, you show me the incentive and I'll show you the outcome. So investors should figure out if management is incentivized by absolute metrics like achieving an earnings growth target, which is easily achieved through an acquisition.
That's right, Ken. And from a profitability perspective, it is important to assess the impact on the return on equity and also the return on investor capital ratios. Often with large acquisitions and potentially equity raisings in the mix, these profitability metrics will be diluted over the short term because the number of shares will have increased, meaning shareholders are actually receiving less return on their investment.
And last but not least, Jace, funding is another key factor to observe as well. If the deal is financed heavily by debt or the target company is in a weak financial position, it could lead to increased insolvency risks because future cash flows are impacted by higher interest payments. Remember, Golden Rule 1 financial health. So understanding the business structure of the combined entity is also crucial as well.
That's right, Ken.
But that's all we have time for today, Jace. Thanks for your time and hope you enjoyed presenting.
Fantastic. Thanks for having me again.
And if any of you have any questions, please feel free to come along to our Lincoln Live webinar on Monday. And also, thank you to all those who attended our masterclass event in Melbourne and Sydney. We thoroughly enjoyed meeting everyone face to face, and we hope those who attended found the content highly valuable. In the meantime, take care and have a happy, healthy, and prosperous week ahead.